makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Danny Berger in London and for Francine. Here's what's coming up on today's program. Stocks get a jolt. European stocks rise and U.S. futures point higher as jobs slow down in America boost hopes of lower rates next year. Traders, meanwhile, fully price in 150 basis points of ECB cuts in 2024. Vladimir Putin visits the UAE and Saudi Arabia today. We're going to discuss the agenda for the Russian president as he makes a rare trip abroad. Plus, CEOs from the biggest banks testify in Washington today before the Senate Banking Committee. Bank of America CEO Brian Moynihan says he sees signs that the U.S. economy is slowing, but still expects a soft landing. Well, it's that soft landing hope that continues to juice this market is the everything rally, and it continues for the most part throughout Europe today. We're continuing to see most of these equity markets move higher. Germany's DAX traded at a record yesterday. It continues to move higher despite Merck, those shares falling more than 10% today. UK stocks up 1/3%. So overall, the rally continues. And what gave us that next leg higher yesterday was the jobs data. Now, the big number comes on Friday, but in the meantime, we had JOLTs come in. That is job openings. It slows down to below 8.8 million. The coolest, again, since some time in a few months here. Sure, it might have been partially done because of the labor strikes, but even so, the market has taken this narrative and has run with it. Mohamed El-Erian says that the Fed is in danger of losing grasp of that narrative. It is an issue of them essentially not being able to tighten conditions if they want to by just jawboning anymore. So let me walk you through these markets. Continue to see an equity market rally both in Europe and American equity futures. They were a little bit softer today. They play catch up today, up about 0.2%. European stocks just hovering around a 4-month high. The bond market also had a very strong rally yesterday, again, predicated on that JOLTS data. But has it gone too far? If it has, then the only direction is higher for yields. That's what we see today, just ever so slightly. We're basically unchanged. Does Friday shake that up with the jobs data? Meanwhile, really one of the cleanest ways to look at what's happening in Europe with 150 basis points priced in for cuts next year is euro versus the yen. We also heard from the deputy BOJ governor hinting that we might be near the end of negative rates. So you get the euro versus the yen falling yet again. It was falling more severely earlier in the day, but now it's down just about 0.1% versus the yen. But still, this thing has been falling for 6 days now. That is the longest losing streak since 2018. All right, so a lot of the concern here is, have we gone too far in this? Now, Citi's economists just recently put a note out saying that we've seen an improvement in key measures of inflation while labor markets have remained tight. With these upside surprises, the probability of a soft landing for the global economy has also risen. Even so, we cannot convince ourselves that we're entirely out of the woods. So what does that mean for your markets if we're not entirely out of the woods? Joining us for more on this is Elise Badoy, head of UK, Europe, and Middle East equity research at Citi. Elise, really great to see you this morning. So that's the view from your economists. If you can't be totally positive that we're not out of the woods yet, do you want to fade the most recent equity rally we've had?
Hi, Danny. Well, I mean, the key is to, first of all, look at the reasons that have driven the rally that we've just seen. It's obviously that a number of risk factors have abated, but have not gone away. I think that's what we're saying. What the European market is pricing right now is essentially, we believe, EPS down some 5%. Mm-hmm. We at Citi believe that EPS should be more in 2024, growing at around 3%.
Okay.
So I think it's this disconnect between... We actually have a relatively bearish view on the macro in Europe, but obviously it's what the equity market is pricing. And those three factors that have been really weighing on the equity market, higher rates, obviously it's fading. We now have an outlook for rate cuts. Secondly, geopolitical risk. We're seeing a de-escalation. They're not going away. And then thirdly, more news for soft lending. I'd mentioned PMIs, for example, bottoming.
Right. But how much, though, of a 2024 equity rally is predicated on cuts next year of 150 basis points of 2024 cuts?
I think some of the easing, obviously, of these policies and cuts coming through is important. but the market is also moving away. And there's a lot of questions around inflation, obviously, and cuts happen for the right or the wrong reasons. So it's this permanent tension between, yes, cuts there will be, but are we cutting because the economy is going so bad in a way,
right.
Or are we cutting because we're just seeing the problems going away, like inflation? And I think that tension is going to be really important, and our investors, our clients, tend to be looking at really these key factors. So watching inflation, it's coming off, but why is it coming off?
I mean, but you look at something like Germany's DAX, for example, which is trading now at a record new high, and then you have German factory orders come in today. I think the drop was something like 3.7%. The expectation was a drop, but not nearly that much. I mean, you look at that and you say, do the fundamentals match? If there is this weakness in German industry, and Germany's DAX, of course, is very cyclical.
I think we need to distinguish, obviously, between the macro news and, again, what's priced in.
Okay.
And I think there's a really, that's where the disconnect is. We still see overall the European market up 10% from here. We had called for this rally, essentially, that we've seen in the last few weeks. And I think that's because, the market was really pricing in something much lower. Where we are right now, in terms of, positive upside and surprises, is, it's essentially looking at, PMI is bottoming. They're still low, but they're bottoming. And bottoming is the signal to buy, essentially.
Right.
Now, another factor that I haven't mentioned is obviously the hope for a China recovery.
Yeah.
And that's massively important for Europe. We all know that Europe, the European market, is not a proxy for European economies, but obviously has a major influence from the US and from China. So whatever happens in China also matters. And again, there we're not out of the hood. Investors haven't seen really what they want to see yet, but we're seeing some positive signs. For example, the latest news on real estate in China.
I mean, it is just really hard to wrap your head, though, around the Chinese data. I mean, you get one set that looks positive, another one looks bad. Is it going to be more about actually seeing the growth happen in China versus stimulus kind of hopes of this before you can price that into Europe?
Effectively, investors are really, really wanting to have more data with China, and just stimulus news seems like it's not going to be enough. That's certainly the feedback we get. So I think seeing more of that will be good news. But however, when we look at the various sectors that we recommend, we think that initially any better news might come and be priced in through metal and mining, even before it comes through luxury goods. And I think that's reflecting exactly just what you've said.
It's interesting because I had a conversation with Deutsche Bank's chair last week, and part of what we talked about, and I mean, he complained about, I should be more accurate, is just how European banking prices just have really struggled to keep up with the rest of the broader market. They have obviously very different issues from their American peers. But what do you make of the sector next year? Also, if they're potentially losing that juice of net interest income from higher rates, is there still further to go and maybe even some catch up to play with European banks?
So we have a neutral rating on European banks, and that's pretty much because we've observed all the points you've just made. And I think, if you look at valuation, obviously they're not very high, but we do have some headwinds, rate cuts. I'd mention also the consumer. Obviously, we haven't talked about it, but one of the potential risks that could materialize, we haven't seen essentially any big issues with financing, with personal financing issues. And in fact, we've had almost like this pent-up demand trade, and retail has done better than investor has thought. All of that means the consumer could have a blip. It's possible in Q1, Q2. There is this school of thought that actually we've moved from Q3 issues into Q1 rather than no issues at all. And that isn't great either for banks. Yeah, certainly isn't. Elise, I'm afraid we're going to have to leave it there. Thank you so much for joining us this morning. That is Elise Badoy, head of UK, Europe and Middle East equity research at Citi. Now, I mentioned this earlier in the show. I just want to give you another check on it because Merck shares are getting hammered. It's the German pharmaceutical company. Now, this is the biggest drop since July 2009, down 14%. The company's experimental MS drug has failed in late-stage trials. Hence, it's getting hammered today, down 14%. All right, coming up in the program, speaking of Germany, the government there is trying to plug a 17 billion euro budget hole next year. Can they seal a deal before Christmas? We'll have that for you next on Bloomberg.
EU finance ministers are expected to discuss a set of guardrails aimed at reining in member states' deficits and debts and at a meeting in Brussels later this week. Now, over in Germany, Chancellor Olaf Scholz says he expects rapid progress on coalition talks on how to plug a €17 billion hole left in next year's budget. Here with the details, it's Bloomberg Germany correspondent Oliver Crook. And Oliver, it's been a difficult road for Germany to get these budget negotiations done. Where do they stand at the moment?
That's right, Danny. And they were going to finalize the budget for next year literally the week where that court ruling came out and just blew everything off course. And now we understand there's a €17 billion hole in their budget for next year. And again, the important context here is that this is a government composed of 3 different parties with 3 very different priorities. And those differences could kind of get papered over when you had a few billion euros to throw around. When those are gone, that's when the negotiations get really difficult. And they're at it. They need to get it done basically immediately, if not sooner, for their political purposes, but really they want to leave this issue behind them in 2023. So there's going to be spending cuts, there's going to be subsidy cuts. Where they're going to come is really the big question, and that's what they're trying to negotiate. We do not have a timeline for when they can get it done. If the cabinet can agree to this in the next couple of days, they can get it done by the end of the year, but that is not at all a guarantee.
I mean, potentially making things worse. It's not like the macro environment is fantastic for Germany either. About an hour or so ago, we had those Germany factory orders, maybe 2 hours ago. I mean, really bad, Oliver. It was a huge miss. We were just talking to Citi about them, who said, OK, perhaps the bad economic data is already priced into this market. But, I mean, this is certainly not what we were expecting in terms of just how bad it would be.
Exactly. And this is really backward looking. So this is October. We had down year on year 7.3%, month on month down 3.7%. But Danny, we also got construction PMI printed this morning. We had a 36 print on that. There's been basically 1 print lower than that in the last 10 years, and that was during the height of COVID. That really shows you how gloomy this economy is. And when you think about how the budget crisis really works into this, for a lot of businesses, what do they love more than anything, Danny? Certainty. What does this create? A huge amount of uncertainty, right? So this is going to be a question of where they're going to be placing their investments next year. If they don't know where subsidies are going to come, how do they know how to place that? And we see it in the data. IFO had a study out this week saying that businesses across the board in Germany are reducing investment into next year. And there's going to be an economic consequence of that, right? We have Deutsche Bank. It was supposed to be the year that came back in terms of growth in Germany. Now Deutsche Bank, as a direct consequence of this budget crisis, expects contraction yet again next year in Germany.
I mean, Oliver, it's kind of crazy to hear you say this, then also say in the same breath, literally like the DAX just hit a new record and is still moving higher today. I mean, is there not some sort of like disconnect here between what's happening?
Totally. I mean, the fundamentals, again, are just are completely disconnected in the market for what we're seeing in the economy. The economy really couldn't be gloomier. The thing that's interesting with Germany, and this is kind of the contradiction and kind of the issue with Germany, is that no one is expecting the sort of German economy to go out with a bang. It's going to go out with a whimper. It's going to go out sort of slowly. And so you can have this sort of grind on. And again, you know, there's also the alchemy of central bank policy and rates and all of that that's going to basically be driving the equity market. But the fundamentals for the German economy are just basically very poor at the moment, and this is what the government needs to deal with. And it comes back to the debt brake. You're looking at it on the screen, the amount of borrowing that they can debt finance in order to get this economy going. Habeck, the economy minister, says that basically Germany is boxing with its hands tied behind its back as a result of this debt brake when the rest of the world is debt financing growth.
Hey, Oliver, we won't tell Powell and Lagarde. You've essentially said central bankers' jobs is equivalent to an alchemist. We'll keep that a secret between you and me. Oliver, thank you so much. That's Bloomberg's Oliver Crook in Berlin. All right, elsewhere in the EU, Bloomberg has learned that the EU is set to recommend delaying tariffs on electric cars traded by the UK by 3 years. Current post-Brexit arrangements are meant to kick in from Jan 1st. Let's go to Bloomberg's car czar, Craig Trudell. Craig, I mean, it's remarkable. I mean, it's some of the last, maybe not the last vestiges, but vestiges of Brexit that are hanging around. What were the purposes of these tariffs in the first place? How did we get to this point?
Yeah, it came from the same, mindset that we're seeing, just in the last week, IRA sort of formalizing, these rules around what battery components and raw materials are going to be okay in order for EVs in the U.S. to be eligible for tax credits there. There was a real desire on the part of policymakers to, incentivize and actually sort of, require for EVs in the region to have local content in order for them to be traded back and forth. What it may have, sort of resulted in perversely is EVs being hit with tariffs that combustion cars would not be hit with. And of course, I think, policymakers on both sides of the channel would tell you that that is not a place where they want to be given the transition that we're trying to engineer here.
Yeah, I mean, awkward literally when COP is happening to
Yes.
to have that be the potential fallout. I mean, beyond that, but because of that, really, Craig, when we do have these duties come to fruition, assuming they do at some point, what will the fallout be?
I think, we may get to a point where this becomes much less of a concern, where we do have much more of a localized supply chain, but we're not there yet. And I think, there are some legitimate reasons for that. Even a company like Tesla that, has a local plant now in Europe just in the last couple of years, they push back plans to make batteries in Germany. This is, for sort of the obvious reason of the state of the industry, that you have a significant amount of battery production in China. You actually have more production than you have, demand for. Much lower costs there than you would be able to sort of, get costs down to in Germany. And, that sort of, state of affairs doesn't look like it's changing anytime soon. There is some real effort to get to that point, but it's going to take time. It's going to take investment. And so there is a sort of, real need on the part of the industry to relax some of these rules to allow for us to get to that end goal.
Right. Well, we'll see if that 3-year delay happens. Craig, thank you so much for joining us. That is Bloomberg's car czar, Craig Trudell. All right. Coming up, Amazon makes a move suggesting it's prepared to go to a price war with Chinese fast fashion startup Shein just on the eve, not the eve, but nearing their IPO. We're going to have the details on the e-commerce battle. This is Bloomberg. Amazon is sharply cutting fees for merchants selling cheap clothing. It's a sign it's hunkering down for a price war with Chinese fast fashion upstart Shein. Amazon says it's reducing seller fees on clothing products priced below $15. It's now going to be 5% for the fee. It used to be 17%. For more on this, let's bring in Charles Allen from Bloomberg Intelligence. Charles, if there's anything we know about Amazon, it's that it doesn't really like to reduce fees, these so-called referral fees for its charges on merchants. So put this into context for us. Is this really Amazon hunkering down, ready to go to battle with its fast fashion rivals?
Well, obviously it is to a degree, because there isn't really a proper fashion marketplace in North America at the moment. And so making sure that you establish one is quite important. And that is to make sure you have as many different brands and merchants on your site as possible. So if reducing the fee to get them on the site is a way to do it, then yes, it makes sense.
How is Shein? I mean, we've been talking about a Shein IPO. It's expected to be massive. How is Shein so successful with merchants and this low-cost clothing model? Because they're obviously not the first to do it, but they seem to really race ahead of many of their rivals.
Well, I mean, there are two different parts to Shein, obviously. The bit that we've heard most about is its own merchandise, that is sourced in a very rapid way, close to its operational headquarters in China, and then it's shipped directly from China to consumers throughout the world. And it's able to do that in a way that seems to mean that it avoids customs duties and local sales taxes as well. The marketplace, which is what we're talking about, is something that's been added on top relatively recently. And I think it's particularly in the US that we've seen the marketplace really come into be an important part of Shein.
Now, of course, I mean, as has been made clear by discussion, Shein isn't the only fast fashion rival that Amazon is facing, but not the only rival with ties to China. How much pressure could Amazon be under, given all this, again, especially with the pressure of an IPO coming from Shein? And just less than a minute here, Charles.
Yeah, I mean, there's a couple of things. I mean, obviously, with an IPO coming up, Shein probably has to demonstrate some profitability. I mean, for Amazon, apparel is a big market where, although it has a very significant presence, it hasn't really managed to make it in the fashion-forward part of that segment, and so it's trying to get into that area as well.
Okay. Charles, thank you very much. That is Charles Allen from Bloomberg Intelligence. Amazon is up, slightly in the pre-market, probably nothing to write home about. It is up slightly, as is Apple today, I should say, still around that $3 trillion mark. All right, coming up, Vladimir Putin heads to the UAE and Saudi Arabia today. It's a rare trip, and we'll have the details for you next and what to expect on Bloomberg. Stocks get a jolt. European stocks rise and U.S. futures point higher as a job slowdown in America boosts hopes of lower rates next year. Meanwhile, traders fully price in 150 basis points of ECB cuts next year. Vladimir Putin visits the UAE and Saudi Arabia today. We're going to discuss the agenda for the Russian president as he makes a rare trip abroad. Plus, CEOs from the biggest banks testify in Washington today before the Senate Banking Committee. Bank of America CEO Brian Moynihan says he sees the U.S. economy slowing, but still expects a soft landing. Good morning and welcome to The Pulse. I'm Danny Berger in London. Now, we are awaiting any news coming out of a trip from Russian President Vladimir Putin. It's a rare trip abroad. He's going to the UAE and Saudi Arabia today. Oil, that's very high on the agenda, and it's trade and negotiations between OPEC+. Joining us for more on this is Raktim Katake, who joins us now from Dubai. Raktim, again, OPEC+, obviously on the agenda. We just had their, perhaps confusing meeting last week. What exactly would Putin be hoping to get out of a discussion around that?
Well, I think, as we know, that oil is going to be quite high on his agenda when he meets with the Saudi Crown Prince MBS. The Saudi-Russia alliance within OPEC Plus remains very, very key. This is at a time when following the OPEC Plus meeting last week, despite a plan to cut production deeper, oil has declined every day since then. So it's a very important time for the market. The market will be looking very closely to what Putin and Saudi Arabia say.
What about geopolitics? Obviously these are countries that have, been put perhaps in awkward situations, not just for Ukraine, but what's happening in Gaza as well. What would be a desired outcome from Putin in terms of geopolitics?
Well, it's a very interesting time for him to be visiting this region. As we know, COP28 is on in the UAE. The world's eyes are on this region, and while Putin is here, oil will be discussed. So it remains to be seen on how he is going to on how COP and the oil market balance each other out. But definitely a very, very interesting time for him to be here.
Yeah, no, it certainly is. Not to mention, there was even some talk, does he go to COP? But that seems very unlikely. Hey, Raktim, thank you so much for this. That's Bloomberg's Raktim Katake. Now, Ukrainian President Vladimir Zelensky has canceled an address to the U.S. Senate. Negotiations are currently stalling there on $61 billion in new weaponry and other aid to his country. The White House has warned that the U.S. could run out of funding for Ukraine by the end of the calendar year. The package is being held up by Republican demands that a majority concession on immigration policy at the U.S.-Mexico border. Now, also one of the most read stories on the terminal this morning, U.S. President Joe Biden says he might not be running for a second term if Donald Trump wasn't seeking to return to the White House. Biden told donors at a campaign fundraiser that the former president poses a grave threat to American democracy. Now, those comments come amid reports that the campaign of one of Trump's major Republican rivals, Ron DeSantis, is in turmoil. Meanwhile, it seems that some of the more wealthy Republican Party are coalescing around Nikki Haley. Now, in company news, Rio Tinto has announced plans to spend more than $6 billion to develop a giant iron ore mine in Guinea. CEO Jakob Stausholm told us exclusively why they think the costly project is worthwhile.
It is, of course, expensive to build a new iron ore mine because you also have to build the infrastructure. But it is an iron ore of an exceptional quality. Probably the highest quality on the planet, and only basically competes with the iron ore mined in northern Brazil. So it's the kind of ore for the future, because a lot of the ore can go straight into a DIR, electric arc furnace process, and therefore you have much less CO2 emission. So it's attractive to get into our portfolio. It's a different quality than what we have in the Pilbara. And we also believe that there's space in the market for this new mine.
With market conditions as they are you confident about the levels of capex that would be required to continue investing in this project?
Oh, absolutely. No, it's a very good project, and it's well down the road. It's 25 years ago the ore was discovered, and we have recently developed it very well. I was traveling to Guinea just 4 weeks ago and went out with helicopters and saw the good progress we are having. So we are basically at a point of sanction, just subject to final approval by the authorities in China, our Chinese partners.
You do expect that China will hit peak steel consumption sometime soon. So this is not entirely a bet just on China?
No, well, there's a couple of things to say around that. First of all, the rest of the world is growing, and whereas China has been at what you call peak level of steel consumption, you can see that India is now coming up the curve, and they will need much more steel in the future as well. So in aggregate, the world will be growing, and don't forget, any mines they are at some stage running out of iron ore. So you have to keep on investing in new replacement mines just to sustain the level of production. We are the world's largest producer of iron ore, and as you would also have seen, we have just announced today a study of developing the Rhodes Ridge. We need to develop more in the Pilbara, and we are developing Simandou.
Are you looking at other assets at this point?
Not in the iron ore area. We are trying to find a good balance between our leading business of iron ore and also being big in with the Western world's largest producer of aluminium, and we have a strongly growing copper portfolio. So it's a matter of finding a good balanced portfolio that fits the future.
Yeah. What is the future of China to you? Because obviously so much of that voracious appetite for iron ore, for steel, has been on the property market, which is in the process of being delivered. Yes,
look, it's always difficult to talk about an economy for the long term, but of course the track record of the Chinese economy is pretty impressive. And right now, I've just been traveling around in China. I'm quite optimistic in a way. The Chinese economy is growing. You're absolutely right. The property market has its challenges. But then again, China is spending more, again, on infrastructure. And there are certain industries that are booming. For example, the automotive industry, particularly the electrical vehicles, and that also helps demand.
Rio Tinto CEO Jakob Stausholm speaking exclusively to Bloomberg Daybreak Asia co-anchor Heidi Stroud-Watts. Now, Russia's income from oil exports is now greater than before the invasion of Ukraine. It's a failure of Western sanctions, and it's the subject of today's Big Take. Joining us now to discuss it is Bloomberg oil strategist Julian Lee. Julian, we've had this price cap policy trying to avoid this very exact thing that we're seeing that adds to Putin's war chest. How has it evolved since its original implementation that's perhaps allowed Russia to continue to see the money flow in?
I think what has changed, I think, is the fleet of vessels that's being used to move Russian oil and the companies that it's traded through. So over the course of this year and much of last year, we've seen the amassing of a vast fleet of tankers that are owned by shadowy companies that very little is known about. The people behind them are secretive. They're set up in jurisdictions that very often are far from Western eyes and Western control. And a growing proportion of Russia's crude is being shipped on those tankers. The price cap effectively said that Western ships, Western insurers, Western service providers couldn't be involved with trade in Russian crude if that crude was sold above $60 a barrel. Those kinds of restrictions don't apply to these shadow tankers because they're owned outside of the Western countries. They're not insured by the recognized insurance societies, and so that has helped the oil to move. The other thing that has happened is we've seen a small number of relatively new, unknown trading companies also set up in places far from the West who have, out of nowhere, started to control vast proportions of the trade in Russian crude.
So what could be the consequences of this? I mean, when you have numbers like this, the first thing you go to is, okay, do policymakers try to crack down on it? But is that even possible, Julian?
Well, I think there's a real difficulty here, and I think it's a tension that lies at the heart of this price cap policy. It was a policy that was introduced in order to keep Russian oil flowing. The European Union had proposed sanctions that, in addition to the bloc zone import ban, would prevent European ships and European-based insurance companies from providing any services for Russian oil whatsoever. The US administration in particular was very worried that that would take something in excess of 3 million barrels of oil supply potentially off the market and would send prices soaring. And there were plenty of forecasts around at the time that said oil would go well above $100 a barrel. So in that sense, the price cap has worked in that it's kept global oil prices lower. How you go forward from this is difficult because sanctions on tankers will hit volumes.
Yep, certainly. All right, Julian, thank you very much. That is Bloomberg oil strategist Julian Lee. Now, I want to bring you some data that just broke moments ago. It is UK construction output has dropped for a third month in an S&P survey, coming in at 54.5. The expectation had been a slight rebound. Construction companies also cut employment for the first time in 10 months. Input prices, meanwhile, declined at their fastest pace since 2009. So maybe easing inflation, but concerns about this British economy. This is Bloomberg. Welcome back to the Pulse. Apollo Global Management says it's getting harder for active investors to beat indexes in public markets. CEO Mark Rowan told Bloomberg exclusively that better returns, this might surprise you, can be found in private assets.
We've had a sea change, not just over a year, we've had it over 15 years. So much of our public markets are indexed and correlated. 80% of volume S&P 500, 60% of the market ETFs. 100% of our returns this year are from 10 stocks, which constitute 35% of the S&P, that traded an average PE of 50. How many of us come in every day looking to buy 50 PE stocks? Not many. And I guess what I'm suggesting to you is that public markets, they're so correlated and indexed to interest rates and to money flows that if you actually want outperformance, you need to step away from public markets. And I think that's happening because we're also revisiting the notion of public being safe and private being risky. This is the framework we used to be in. Private meant venture capital, hedge funds, private equity. Now it just means less liquid.
Is that not inherently a risk in your mind, liquidity?
Well, liquidity is a risk to everyone, but in differing degrees. So if you are a retirement plan or a retirement system, you know your liquidity requirements for the next 10 years. So if you can get paid for illiquidity, why not get paid for illiquidity? If you're a wealthy individual, how many of them need 100% of their money on Tuesday? If they don't, they should get paid for illiquidity. And we're seeing that in the performance data. If you look at the active management has failed to beat the index 85% of the time for 20 years. And I think it's going to get harder, not easier, to beat the index. As more and more of the market is indexed, very little money is left to actually make up what needs to be done in active management.
What is the single operational distinction between Drexel, Burnham, Lambert, and Europollo? What is the micro idea you can give us of then versus now?
I'll give you Drexel, I'll give you Lehman Brothers, I'll give you Bear Stearns, I'll give you SVB, I'll give you First Republic. The financial institutions tend to die of one of two causes, heart attack or cancer. Heart attack is funding risk. They borrow short and they lend long. Cancer is the slow addition of poor quality assets, which over time undermine the system. So you look at all of those firms, all of those had an element of both heart attack and cancer, funding risk as well as asset risk. You look at what we're doing. We are borrowed long and lent long. Everything is matched. Everything is in a fund. There is no daily liquid, quarterly liquid money at Apollo. We are ideally situated to take advantage of less liquid assets. We've structured ourselves that way. And then you look at the totality of what we do. Equity is a risk business. Equities go up and down every day. You can lose money in public equity. You can lose money in private equity. In the credit business, the vast, vast majority of what we do is private investment grade.
When I look at the risks out there and to translate it into Nassim Taleb and all the work he did in quant with Black Swan, what are the tail risks you see right now for private equity? I mean, are you hedged perfectly? Is there next to no delta where you feel so comfortable? Or are there actual tail risks at Apollo?
I don't think there are tail risks, and I don't think there are tail risks in private equity. I think private equity is a risk-taking activity. But each of the companies, each of the situations is idiosyncratic onto itself. And over time, private equity has proven to be a very good asset class, recognizing that in certain markets you will lose money.
That was the Apollo CEO, Mark Rowan, speaking exclusively to Bloomberg's Tom Keene and Jonathan Farrow. All right. Now we have some IATA lines coming across the terminal. This is, of course, the International Air Transport Association. They have doubled their airline industry profit target for 2023. They now see $23.3 billion. So it is a record revenue. With the pandemic in the past, that would be a record. But after that, it'll continue in 2024, but it will moderate. They say $964 billion is the revenue for 2024. And that compares to $896 billion for this year. Now, in the next hour, we are going to be joined by the IATA Director General, Willie Walsh, on these record-breaking figures. Now, coming up on the show and later today, bank CEOs are going to be on Capitol Hill. We're going to discuss what we can expect from Jamie Dimon and Jane Fraser. This is Bloomberg.
The problem is that when you have a new idea, everybody wants to look at all the negative aspects of it, and it blocks you from building the first one. Once you build the first one and you see it successful and people understand the value, then you can keep going. And so I think we view new ideas from a lens of why doesn't it make sense? Rather than saying, hey, this is a great idea, let's build a couple of them and then we'll figure out if there are negative impacts. Or we figure out how to make those negative impacts go away. We tend to paralyze ourselves, overthinking, always overthinking when a new idea has got an opportunity to have an impact. There's no time for that anymore. We need to really focus on outcomes and how do we reduce carbon. Every carbon we prevent from going into the atmosphere is a massive win right now.
Jennifer Holgren there, the CEO of carbon recycling company Lanza Tech, on her company's technology and the barriers to innovation. You can watch that full interview on Leaders with Lacqua Goes Green, 9:30 p.m. New York time tonight. And across Europe, you can catch it on Thursday, 6:30 p.m. London time. Now, first to pay attention for later today, the CEOs of big U.S. banks are heading to Capitol Hill today for the annual oversight hearing. They are expected to make their case for watering down rule proposals they argue will harm the economy. Let's go to Bloomberg's Jenny Serrain for more. Jenny, what comes to mind is Jamie Dimon saying that, private capital is dancing on the street on new regulation. Is that kind of the vibe of what we're expecting to hear today?
Absolutely. I think that's going to be one of the main things we hear out of these CEOs is really trying to hammer home for the Senate committee that they think these rules will not only hinder them from making new loans, but they just think that they're misguided. So we're expecting a pretty strong opposition to what's coming.
Yeah, exactly. We can maybe expect some of it. It will still be interesting nonetheless to hear what they say. Elsewhere, Goldman, they're setting aside more for compensation. This isn't the first time we've heard this from Goldman. I know it was their asset management arm not that long ago. Is this just Goldman specific because they've had some of these image issues, or is this, hey, maybe bigger pay is coming back for the rest of Wall Street?
I think it's a little too soon to call it for the rest of Wall Street, because I think you're absolutely right. Goldman does have these sort of one-off issues. They've had a lot of employees, making these public snipes and complaining about the measly bonus payouts they got last year. So I think in some ways this might just be Goldman trying to kind of get on better footing on that front. The markets have just been so quiet in terms of M&A and deal advisory. So I don't think we're expecting a huge increase in bonus payouts this year.
Yeah, fair enough. I mean, you got to show up if you want that payout. Jenny, thank you so much. That is Bloomberg's Jenny Serrain. And we will be covering that Senate testimony across TV and radio for you on your terminal. TLIV Go is where you want to head. And by the way, speaking of M&A needing to come back, we're going to be speaking with Citi's head of asset management, Citi's head of sponsors, Anthony Diamandakis, in the next hour in about 30 minutes time. So we'll talk about that outlook and, whether maybe bonuses are coming back. First, your check on Bitcoin and gold, though, as we head to the end of an hour. Bitcoin still trading above 43,000, just nearing 44,000. It is still the ETF hope, but I love how IG Australia, Tony Sycamore over there put it. Surely the ETF story is well and truly priced right now. Maybe this is just benefiting from that Fed pivot. Gold gets a little bit of a boost today after tumbling 3% in the past two sessions after hitting a record high. All right, you're not rid of me yet. I'm going to be back after the break with Manus Cranny for Bloomberg Brief.